Thank you very much, Matlo. As always, it's a great pleasure to present to you our 10-year view for the agricultural sector and where it's headed. Of course, this year, COVID-19 has clouded it in a lot more uncertainty that might normally have been the case. But it's also given us the opportunity to think about agriculture's role and where it fits in the economy and how it can assist to put South Africa on a more sustainable growth path going forward. So I'll start off with the chart that you've already seen from Fadi, but present maybe a little bit more detail. And on screen you've got the real agricultural GDP in South Africa since 2000 and also over the outlook period. And what we see is that agriculture by its nature is a very volatile sector, so we've had a lot of up and down periods. Historically, we've had periods of decline which were always followed by some recovery and good growth. In many instances, this was supported by a range of international factors, in 2006, 7, 8, we had the introduction of biofuels, we had a Chinese economy growing very quickly. In 2012-13, we had climatic conditions in the US which supported price levels. But we've also had a period from 2010 through to 2016 where we really had sustained investment into South Africa's agricultural sector and strong export-driven growth. So if we think about the future and where we're going, we have to consider again the international environment. We've got an environment where we have high stock levels following a period of multiple years of above average production. And we've also now post-COVID got a low growth environment from a macroeconomic perspective, so the demand prospects are much weaker than what they might have been a while ago. Domestically, similarly, we've got in 2020 good support from the exchange rate. So while we had some sectors doing exceptionally well, we have, for instance, the second largest summer crop on record. We also had exchange rates supporting prices for good, strong horticultural crops. And so the sector's performing very well in 2020. But after that, when we return to more normal volumes, we also hit by the reality of this low economic growth environment and weak demand prospects. So for that reason, the sector's pretty flat for the first half of the outlook. Over the second half, we do start to get some recovery. This is also when global stocks normalize, the economic environment starts to recover a little bit, and our animal feed and horticulture sectors in particular start to perform better. If we look then to the subsectors, we've got now on screen just a stacked bar that shows you the contribution of various subsectors to South Africa's economy or the agricultural economy. Livestock typically about half of the sector in terms of revenue, and then we've got about 25% attributed to field crops and also to horticulture. So if we look then at performance over time, you'll see on screen again the real gross production value from the three main subsectors in South African agriculture. And strikingly, field crops is obviously a lot more volatile than the other two, and that has to do with a lot of the production taking place under dryland conditions. Accordingly, the production and the volumes are a lot more volatile. And we also see that in the past few years, the real value from the sector has actually showed a strong declining trend. In 2020, we do have some recovery. We have, of course, a good crop coming in, our summer crop, good volume. While that would normally put prices down to export parity levels, this year that level is also supported by the weak exchange rate. And so the year-on-year decline that we might normally have seen when we get such a big crop doesn't actually occur. Going forward, when the volumes normalize, we see then that the sector also returns to this longer-term declining trend. If we look towards animal products, this is a sector that really benefits from this declining trend on the field crop side. So the sector has performed quite well and quite consistently over the past decade. But then in 2020, owing to its sensitivity to consumer spending power and also a lot of the food service industry being closed through the lockdown period, we actually see a decline in the revenue from the animal product sector. Going forward, we do see some recovery, firstly driven in the early years by poultry and some actions implemented there from the poultry master plan, and in the second half of the outlook by the beef sector, which is very much based on export-driven success. The star performer then from the past decade is horticulture, and we'll see a really rapid increase from 2006 all the way through to 2014, where the sector performed very well. In recent years, it has been influenced by weather conditions, so drought conditions in the Western Cape in particular, making life a little bit difficult. In 2020, we have again the biggest citrus crop in a very long time. This, together with prices which again have held firm in the international market as consumers look towards product with high vitamin C content, and also the weak exchange rate, which has supported prices and consequently revenue in that sector. Those conditions are expected to normalize in the short term, but in the longer term, we are still looking at growth with a lot of additional volume coming into the horticultural sector. In terms of key success factors that might assist us to get to this accelerated growth scenario, on animal product side, we really have to look at animal health and the general competitiveness of the trade environment. If we can improve the general health status of our herd, that will enable us to grow faster, to export more products into the global market. From the horticultural side, we have got good volumes coming into production, but we need to make sure that we have good enough market access for these products to go into. We need to make sure that we have the infrastructure to support the volumes coming through the market and also to get a good value for those products. In terms of field crops then, in a sector where revenue is coming under increasing pressure, it of course all becomes about productivity gains. So we need to look at sustainable rotation systems and diversification within that mix. Having said that, for all of them, all of these contributors are really aimed at creating an environment that's economically sustainable. But then we also have to think of inclusivity and all the idle resources that we have that we can bring into production. We want to make sure that we bring those resources and those new producers into an environment that's doing well economically and has prospects for success going forward. So COVID-19 really has changed the world we live in, and in terms of its impact on the agricultural sector, you can really separate those into three tiers. Firstly, from a value chain interruptions perspective, we've had lockdown measures imposed. In many instances, this is limited trade, not in agriculture per se, but in many of the support services which allow agriculture to operate efficiently. There's of course the risk of disease outbreaks among employees, the social distancing requirements which limit the capacity in many of the processing facilities. But in general, agriculture has really risen to the occasion, where we've seen some price volatility associated with these availability spikes. The sector's done well and ensured that we have food on the shelves in a fairly uninterrupted manner. The longer term aspect is the economic environment and the impact that the lockdown action has had. So this of course influences the disposable income of your consumers and the ability to afford food. You have lagging unemployment, and while this impact on the economic front is more indirect, it's much longer term, and then we end up in a situation where prices are a little bit weaker because the demand prospects are not that good. The third one is, of course, the policy response to all that. Internationally, we've seen some countries responding by restricting trade volumes. So we're expecting that countries, with COVID having shown up some logistical challenges and risks associated with international trade in periods such as this, we do expect that some countries will push domestic production, support domestic production growth, so that maybe they're less reliant on international trade, resulting in a broader shift in global trade patterns. So if we look at the impact of COVID on food prices, that volatility is already evident. So on screen, you've got the FAO food price index for specific commodity groups. And you can see there that the striking ones are vegetable oils and sugar, where prices had increased towards the end of last year based on supply concerns. When the lockdown action was imposed and the demand side weakened drastically very quickly, those prices really plummeted, and that's to a big extent associated with industrial demand. So cereals, which is a more basic food staple, prices have remained more consistent, but then you've got meat and dairy products where your consumer is again more sensitive. We saw prices decline quite significantly in the international market. If we look then at some work done by our colleagues from the OECD and the FAO, you'll see an interesting scenario where the solid lines represent what international vegetable oil and poultry prices might have looked like pre-COVID-19 or the baseline. The dotted line then shows a change or an alternative scenario where the macroeconomic effect of COVID-19 is incorporated. The shaded area at the back presents a range of scenarios which might have occurred if one looks at historic volatility around the baseline projection. And what this really shows us is that for both vegetable oil and poultry, prices actually declined beyond that level of what one might have expected given the historic volatility in the sector. So in terms of the global macroeconomic environment, on screen we're comparing the 2008 and 2009, the global financial crisis, to the current situation based on the June projections from the IMF. What's clear there is that the global economy, while it did decline marginally in 2009 with the financial crisis, a lot of this was actually centered in a few advanced economies. It was a very specific thing that went wrong. Whereas 2020, we're looking at a situation where the supply side and the demand side have been impacted. We've got advanced economies and emerging economies impacted, and we're looking at a global reduction or global contraction of around 5%. The OECD has this contraction at 6%. So there's a range of projections there, but the sheer magnitude of this shock is way, way bigger than what we saw through the global financial crisis. For South Africa then, we're showing you on screen an index of the real GDP, and you can see the big decline happening in 2020. So while we did see growth slow over the past few years based on a lot of structural challenges in South Africa's economy, the COVID-19 impact has really just accelerated and made a lot of those impacts worse. So we're looking at a contraction of around 9.5% in 2020, with a slow, prolonged recovery and only getting to the actual GDP level of 2019 by 2026. At the same time, the general risk aversion evident in the global economy has resulted in quite a severe depreciation in South Africa's exchange rate. This, of course, has supported prices for many of our agricultural products. Going forward, we do expect some recovery and a much flatter growth path going forward, with some stronger depreciation in the second half of the outlook. So on screen, you've got South Africa's population disaggregated by expenditure decile, and then summed up into three broader groupings of low-income households, middle-income households, and affluent households. So the lowest 40% of the population there, these are the share of the population that's spending roughly 30% of their income on food products. And these are the consumers that have been hardest hit also from an income perspective. A recent survey conducted on 10,000 South African households indicated that up to 47% of people ran out of money for food in April. If you compare that to the household surveys conducted in 2018, that number was only 21%. So this really points to quite a significant humanitarian crisis arising from this current situation that we find ourselves in. Of course, beyond income dynamics, there's also population dynamics to consider when one thinks of the demand structure in the agricultural system. On screen, you've got a heat map which shows the extent of urbanization in South Africa's population in 2011, which was the last time we had a population census done. Since then, we've increased the share of population residing in urban areas from 61% to around 66%, and by the end of the coming decade, that's expected to increase to 71%. So normally, when consumers move to the more urban centers, they do so looking for a higher income and better living environment. One then sees changes in the dietary composition, so you see consumers moving to products that have a higher convenience factor. They generally have better access to things like refrigeration, so the product mix can diversify. But all of that is, of course, also dependent on them actually being successful in attaining a higher income and getting a job in the urban centers. In South Africa, with a high unemployment rate, you do often end up with a situation where people move to the cities, they're unable to find a job, and they've now lost the production prospects that they had in the rural areas to supply some food for themselves. So many of them actually ending up worse off. Of course, there's also the need to consider the sheer size of the population. So on screen now in the bar chart on the right, you've got population growth historically. So over the past decade, our population expanded by around 19%. To 2025, we expected to add another 9%, and by 2030, another 5% to that. So this, of course, adds additional consumers, adding additional demand, but much of the structure of that demand and the products that will be demanded depends then on the success of that growing working age population in finding employment. So how these changes in income affects the dietary patterns that we see amongst consumers becomes quite clear if one looks at evidence from the Income Expenditure Survey in South Africa. There's some distinct product groupings. If you look at fresh cabbage and maize meal, for instance, as consumers move from the marginalized to the middle income to the more affluent groupings, they actually spend less money on these basic staple type products. For another group then, we've got a situation where your consumer, as he moves from a marginal to a middle to a higher income, you originally would consume more of the product or spend more on the product, and then that declines again as you go to your more affluent groups. Much of that is often associated with health concerns, and then the last grouping speaks very much to your more luxury type products. So here you've got cheese, you've got your more processed products, and specifically also meats, where as you move from lower to middle to higher income groups, you actually spend quite significantly more on these products. In some cases that entails buying more quantity, but in some cases that also entails changing the product mix within these products. So maybe moving from your cheaper to your more expensive beef cuts. So on that note, we can then move on to the more detailed look at the outlook for South Africa's animal products. These are the products that we've just seen are particularly sensitive to changes in consumer income levels, and so if we look to demand over the coming decade, we see quite a drastic slowdown relative to what we've seen in the past. This doesn't mean that there's no prospects for production growth. However, we do have some sectors which are very competitive and can look beyond our own market to grow very much based on an export-led approach. And we also have others which have formulated very coordinated strategies to allow them to replace imports going forward. In order to do this, we must prioritize productivity, and we also need to make sure that we improve the general health status of our herd. Turning again first to international markets, we've got on screen the FAO meat price index, so then just showing relative movements of different meat types in the international market. And what's clear that from the beginning of the year, when the COVID-19 impact hit, prices have declined quite drastically. We have seen some turnaround in lamb prices in particular, as supply has been constrained for some time, and as some countries start to raise import demand again as they come out of lockdown, we have seen some increases there. But particularly your lower price products, things like pork and poultry, prices have declined quite drastically. If you relate that to South Africa, however, we have had quite a strong offsetting impact from the exchange rate. So while we saw meat prices globally decline quite substantially, in South Africa we saw small declines for beef, or comparatively small declines for beef and pork, but poultry prices have actually held up fairly well, being based predominantly on import parity levels. And lamb prices, while they decreased initially under the lockdown situation, they have actually recovered quite strongly since. So if we look towards this meat consumption growth, what you see on screen is a comparison of average consumption levels for each specific meat type from 2017 to 2019, and we compare to that then 2029 at the end of the outlook period. What's clear from the beginning is the dominance of chicken within the broader meat sector, so it's the most affordable meat type, and for many it represents the entry point into the meat market. For that reason, it's also critical in this lower income environment. Historically, over the past decade, we saw about a 25% expansion in chicken consumption, and over the coming decade, we expect that to slow quite significantly to 12%, but with production increasing and South Africa able to reduce the share of imports in our total market space. Beef is the second biggest product, and here we have an interesting situation. If you think historically, our beef consumption actually increased very drastically. In the decade preceding 2016, it increased by 17%. But then post 2016, where we had the big drought and we were facing some supply constraints, we saw prices increase quite rapidly and demand or consumption actually then decreased again by 8%. Looking forward to the next decade, we do expect additional supply to enter the market, which would normalize prices in real terms, and so we foresee growth of 12% over the projection period within the beef sector. Pork is a small meat in terms of consumption volumes, but it's an industry that's grown very rapidly in the past. So over the past decade, we saw growth of around 40% in pork consumption. Over the outlook, that's projected to slow to around 20%. But this industry, of course, consumption on a per capita basis is still very small, and it's an industry where we do still foresee more growth if we can get certain factors right. The interesting one is sheep, which is a sector which also over the past decade has actually been in decline. So from a production perspective, they're faced with multiple challenges in terms of climate, but also in terms of theft, livestock theft and predation in the areas that we produce. So going forward, this is the most expensive meat type, so we do have a sensitive reaction in terms of income levels. But we also see prices increasing further over the outlook because of that supply constraint. So all things considered, then we see consumption of sheep actually declining by 11%. And if one thinks around turnaround strategies and what the possibilities are to get the sector growing again, you almost need to look to a sector like beef, which drove the turnaround based on accessing export markets and exporting premium products. So in terms of consumption growth, we've said a lot about the income levels, but there's also relative affordability to consider. And in that respect, you have products such as beef, which is actually generally a more expensive meat type if you think in terms of carcass prices. But in retail level, it's got quite a range of products. So you've got beef offal in your affordable meat cluster, you've got beef mince in your middle price cluster, and then you've got beef fillet in your luxury cluster. So we have to acknowledge also that within each meat type, there are different products which are aimed at different consumer target markets. If we look then also on the expenditure that we see on the relative meat products, you'll see that something like lamb, which is generally most expensive, the bulk of the expenditure on lamb products is coming from your more affluent consumer base. As you move right then towards beef products and ultimately eggs and chicken, your most affordable protein source, you have a rising share of expenditure coming from your low-income households. The interesting one here is pork, because despite being quite an affordable meat type, you actually have quite a big share of your expenditure coming from your affluent consumer base. and this has a lot to do also with the level of processing and the value added to the product prior to consumption. But for pork, there's also multiple other factors that affect consumption that don't speak specifically to economics, to income and price levels. On screen, we compare meat consumption in South Africa to what we see on average around the world. From there, it's clear that while pork globally is as important as chicken, constituting 37% of your meat consumption mix, in South Africa it's really small, accounting for only 8%, with 65% coming from chicken. Now, much of this has to do with cultural reasons as well, and there's some religious dynamics to consider of people that don't consume pork. But generally, it's also a product that's not so well known to a broad part of South Africa's consumer base. And recently, we did some work funded by the RMRD South Africa, which looked specifically at consumer expectations and consumer concerns related to pork products. So amongst the expectations of what consumers want to see from pork were factors such as affordability, value for money, especially also food safety, freshness, visual appeal, a lot of these factors speaking to quality and integrity aspects. On the concern side, raised across the socioeconomic spectrum, again, was quality. People perceived pork to have a high fat content, many saying it has a bad smell, that it's a dry meat. There was also concerns raised to food safety. And what this all points to is that for a sector where per capita consumption is still low, there's actually a lot of scope to improve the image per se of the product if one can really ensure the integrity of pork products and market it to consumers to overcome these perceptions. There's a lot of scope for consumption growth within that sector. Pork is also interesting because it has a very big informal component. So what we've spoken to earlier speaks very much to products procured through the formal value chain in retail stores. But if you look at household level information in South Africa, you see that in addition to our formal sector, we've actually got more than 200,000 households engaged in pig farming. That amounts to almost 900,000 pigs within the sector, and if you equate that to what we know about the formal sector and the number of pigs in that, it suggests that 38% of our national standing stock is actually within the informal sector, and a very small share of that actually moves through abattoirs and through the formal processing sector. A lot of it is sold live, directly to consumers, and what it suggests is that we're actually undercounting our pork production and consequently also pork consumption numbers by around 10%. If we look towards the pork market outlook then, we have a lot of factors to consider again. So we've got on screen on the chart, we've got the area at the back which shows pork consumption historically and also pork production historically and also over the outlook period. We've got the bar indicating imports, and then as an indicator of relative profitability, we've got the pork to maize price ratio. So there again we see a lot of volatility. We see that from the period between 2013 through 2016, where we had high feed prices, we had drought conditions influencing our feed grain sector, that ratio fell very low. In 2017, when we had the bumper crop, it recovered to an all-time high. So we have seen profitability increase, but then in recent years, we've also had some dynamics associated with listeria, things like African swine fever, foot and mouth disease, which has put pressure on pork prices. Going forward, that profitability ratio does recover, and a lot of that is based on the fact that the productivity gains achieved in the maize sector is actually faster than what we've seen in the meat sectors. So we have real maize prices declining over the outlook, whereas our real meat prices remain fairly consistent. That's not to say that we haven't had productivity growth in the meat sectors. Pork, for instance, over the last decade, we saw herd numbers decline actually by 11%, but at the same time, production increased by almost 50%. Over the outlook then, with your profitability ratio stabilizing at levels better than what we saw in 2015-16, but not quite the highs of 2017 and 18, we see production growth of around 2% per annum. This is sufficient to replace some of the imports that are coming into the market. We can also arguably do more in that respect if we can improve animal health and biosecurity, particularly in the informal herd where we have a lot of scope for productivity gains. But the reality is also that South Africa imports a very specific products in the form of pork ribs, and those are unlikely to go away because it plays a role in balancing the market, so to speak. If we look towards chicken then, this is of course the other industry which is very dependent on the feed grain sectors for its own competitiveness. And if we just take a look historically from 2000 to 2010, South Africa added about 700,000 tonnes in chicken consumption. Of that, 86% was supplied by domestic producers. If we move to the next decade, we added around 500,000 tonnes to domestic consumption, But the turnaround here is of that additional growth, only 43% was supplied by domestic producers with the balance imported. So this suggests that we've really struggled to compete with imported products. And if we break that down, looking at what exactly those products are, we see that the bulk of growth in import volumes has been attributed to bone-in portions. In this extent, then the product that competes very directly with individual quick frozen portions in South Africa, which accounts for about 65% of South Africa's chicken market. The industry, through this struggle with imports and being classified as an industry in distress, went through a process of formulating a master plan designed with very specific goals of containing imports and growing domestic production. So there's a combination of actions proposed in this master plan to assist the industry. A lot of it has to do with the trade environment. So we've got a review of tariffs, we've got the legislative framework which speaks to labeling and traceability, putting those products on very equal footing to what's expected from domestically produced products. We've also got a framework which enables SPS compliance so that we can export breast meat. If we can export breast meat at a premium, that'll allow us to compete more efficiently with the bone-in portions, which is where we traditionally struggle. And then there's also very specific actions in addition to imports that speaks to growing productivity and increasing production, not only amongst our big producers, but also amongst our smaller, more informal producers. Of course, productivity is key if one wants to achieve this, and so we're showing on screen the relative cost of production in specific set of countries compared to South Africa. So you'll see by the countries on the left that most of the European countries, it's more expensive to produce a chicken carcass than what it is in South Africa. But if you look towards the right, countries such as the USA, Brazil, Thailand, Ukraine, which are big exporters in the global market, they're still able to produce a carcass cheaper than what we can in South Africa. And a lot of that has to do with them being net exporters of feed products, which then in turn reduces their cost of production. The reality is, though, that South Africa has an advantage compared to these other countries when it comes to the EU specifically. So we have the Economic Partnership Agreement, under which we have preferential tariff access to the EU market. So if we are able to produce relatively competitively, we should be able to access this market, particularly for higher value and higher priced products such as your chicken breasts. We haven't done that to date, mainly because we are unable to comply with food safety and SPS related measures. The industry strategy going forward is firstly to put the framework in place to enable this compliance, but also to look towards more value-added products where we can add some value and cook some products before we export them, which then makes it easier to comply with the SPS measures. These products would then be targeted very specifically at the EU, but also in the Middle East, where South Africa has become quite competitive in terms of supplying meat products. So the impact of all of that, if we look then towards the outlook for chicken production, we see that the very similar trend in the chicken to maize price ratio than what we saw for pork. So the drastic recovery in that profitability ratio in 2017 and particularly 2018, those factors combined with the actions underlying in the poultry master plan then give us quite significant growth over the next few years in poultry production. Over the second half of the outlook, that slows again, and with the recent introduction or the recent increases in the tariff rates combined with the weak exchange rate, we have seen some price support, making imported products relatively more expensive. So we see some reduction in imports in the short term, but in the longer term, still remaining a factor, not going completely away, but certainly also not growing at the rate that what we've seen historically. Poultry traditionally is not a sector that's associated with inclusivity. It's obviously an industry that depends on scale of production. So we've got quite a concentrated industry producing in a highly integrated value chain, achieving top efficiency levels, but requiring scale to enable the investment into this top production technology. The other side is that we also have more than 1 million households active in poultry production. If you look towards the map on the right, you'll see that a lot of these producers are also situated in the rural areas. So while there's many of them, they produce at a much lower scale and so contribute a much smaller share to total production. They are also faced with challenges in terms of input costs. Input costs tend to be higher because you can't procure in bulk, and it's also expensive to move the inputs into these rural areas. So if we can enable grain production in these areas and grain processing, if we can give them better access to cheaper inputs, if we can broaden their markets by making available slaughtering facilities and storage facilities in terms of refrigeration, we really can expand their market, allow them to produce a cheaper bird and expand their market in these rural areas. So if we move on from the import replacement strategies then into the more export-led development, we look at beef, which has really been one of the success stories in South African agriculture over the past decade. On the map, you see the change in South Africa's beef exports over the last 10 years. The green showing where we had a higher increase in our export volumes. A lot of that growth has been targeted towards China, which in the process has become the biggest share of South Africa's total beef exports over the past few years. Growth has also occurred into the Middle East region, and the products that we export into these regions are very much your higher value products, your more expensive, so we obtain a good premium in these markets. At the same time, we've reduced exports into some of our neighboring countries a little bit because the mix of products demanded in these countries is quite distinctly different. So if you look on the chart on the right, showing the composition of South Africa's beef exports on average from 2010 to 2012 and comparing that to 2017 to 2019, you'll see a lot of the growth has occurred in boneless cuts, some bone-in cuts as well, but predominantly fresh and frozen boneless cuts. The strategy here is very much then associated with an optimization of the beef carcass value. So what producers have done is they've exported cuts typically associated with the hindquarter, done that into markets where they can obtain a good premium for that, and the rest of the carcass or the forequarter products then come into the South African market and also some into neighboring countries, and the premium that we obtain for the higher value cuts then enables us to sell these cheaper cuts locally at a more affordable price. So if we look towards the beef market outlook then, we've got again production shaded into the back, we've got some profitability ratios, we've got the beef to maize ratio, and in this instance also the beef to calf ratio. And if you look at those, you'll see that it's really been a volatile period for the industry over the last 10 years. So while we have attained average annual growth of around 2%, a lot of that came leading up to 2016. The drought conditions then forced us to slaughter into our breeding herd. So for the next few years, we entered a rebuilding cycle, particularly also when production became more profitable in 2017. That cycle unfortunately takes some time. So we have been in that cycle for a while, and over the next 2 to 3 years, we expect some of that supply to start entering the market, which will of course also affect our beef prices. In terms of growth going forward, we're expecting production growth of around 1.4% per annum, a lot of that underpinned by growth in exports. Our exports over time have also been challenged by disease outbreak. We saw in 2019 when we had the foot and mouth disease outbreaks that exports halted suddenly and had quite a significant price impact. Since then, based on compartmentalization, some of the feedlots have been able to negotiate bilateral agreements with trade partners. And while we still haven't been declared free of foot and mouth disease again, we have actually started exporting beef again. So going forward, that beef to maize price ratio also improves over time, again based on the real decline in feed grain prices. This improving ratio then also enables our feedlots to pay a bit more for the calves, which in turn benefits your smaller producers, which can supply weaner calves into the system. The other industry that's done very well in the export market is wool. So if you look historically, South Africa in 2009 exported about 35,000 tons of wool. We managed to grow that to almost 50,000 tons by 2018. In 2019, we had a sharp reduction also associated with foot and mouth disease, but the inherent traceability possibilities within the industry has also then enabled it for exports to resume again, although a lot of the product which might have been exported in 2019 only actually left the country in the following season, so we've got a big spike. Going forward, we do expect that growth to slow. Firstly, that's because production growth slows over the outlook based on challenges such as theft and predation, but also because a lot of the historic growth in exports was based on a redirection of products that might originally have been processed in South Africa and instead were targeted into the export market, where South Africa's high quality wool actually fetches a premium over most of the other countries that we compete with. We have reached a bit of the limit in terms of that strategy. However, currently we only process around 3% of our domestic wool clip locally, and so a further redirection strategy is not necessarily possible over the outlook. So the other product where South Africa has been very successful in the export market is mohair. We actually supply 47% of the global mohair market, and we do so also with a very high quality product which typically fetches a premium in the global market. The real success story with wool, however, is not only the growth that they've shown, but also the inclusivity of this growth. So if you look at the chart on the left, it shows you the contribution to total wool production from large-scale commercial producers and our communal areas. And you'll see over time from the early 2000s, that share has actually increased quite significantly. On average, for the past 3 years, we supplied roughly 5,000 tons of wool from these communal producers. If you look towards the right, that also shows the national average wool price and compares it to the price attained by these communal producers. And the grey line then shows you the ratio between these two prices. And what we see is that over time, the communal prices have actually caught up to the national average price. So that premium has actually declined over time. So that would indicate that your communal producers have caught up in terms of quality, producing a higher quality wool that's more comparable in your national framework. But that's not to say that it can't be improved further. So in many cases, these producers are too small, and the clip has to be combined within the shearing sheds with a lower quality wool, which then doesn't enable them to get the full value for the wool that they have, the quality wool that they have produced. We've spoken a lot about expansion, particularly from our extensive livestock sectors, but the reality is that we have to also consider the resource base. So on the left, we're showing a view towards grazing potential in South Africa. So all the green and yellow areas reflect possible grazing potential. The black areas reflect planted pasture, which we can then look at. The red area is South Africa's crops currently being produced. On the right then, we've indicated the major extensive livestock. So we've got beef or cattle in general, we've got goats and we've got sheep, and we've expressed them all into large livestock units. So essentially this gives you some view to the demand for grazing, so to speak. What's concerning, if you look at that, is that the high density area of livestock overlies very well with the white areas in your potential grazing chart, which is actually areas that are already under pressure. So these areas are either built up, or you've got erosion, you've got degradation of your quality. The areas have already been overgrazed, and the concern is that these high livestock density within these areas will also only make these challenges worse going forward. So the other sector that's also dependent on this grazing is, of course, dairy. So here we've got a very interesting sector. If you look towards the past decade, we've seen a lot of consolidation in terms of producer numbers. So the number of producers in the sector has actually declined by 65%. But at the same time, milk production increased by more than 30%. And we saw also earlier in Fadi's presentation that the sector has actually already exceeded the growth targets that were set for it under the National Development Plan. So that equates to growth of about 2.9% per annum over the past decade. This is a very finely balanced industry. It's fairly competitive in the global context, but demand and supply is very balanced, so prices can be volatile. And we've seen a lot of pressure in terms of costs and actual product prices in the past. This is also one of the reasons why we've seen this consolidation, as the producers that have remained in the sector are those that are able to invest in top production technology, produce at scale, and can therefore ride out these cycles a little bit better. One also has to note that the consumer base for dairy products differ. So if you look at the composition in the back of dairy product consumption, we've got around 40% going to concentrated dairy products and around 60% going to liquid dairy products. So your liquid dairy products would be your fresh milk, your UHT milk, and then a little bit of value-added products such as yogurt. But this would be a big supply into your lower income levels, and then your more concentrated products, your cheese, your milk powders, and your butter would be targeted more towards your higher income consumers. So to wrap up the animal product sector, we then want to speak to a few key factors that we feel really can accelerate growth in the sector. The first relates specifically to the general status, South Africa's herd health. That goes hand in hand with the livestock traceability system. So this will enable us to better understand our smaller producers, where they are, how they do business, and quantify their contribution. It'll also enable us to manage our diseases much better, and that in turn then broadens our access to markets for our exported products. The other side is that major productivity gains are possible, specifically in the informal sector amongst our smaller producers, but we also have to make sure that these producers have efficient, transparent markets to deliver into, and we need to make sure that we do the recent research and development to actually attain this productivity growth. We need to make sure that we compete on a level playing field. This speaks specifically to imports, but also to the fact that we need to be able to certify, and we need a framework to enable us to comply with food safety and SPS regulations, and also access broader export markets. Other than that, we need a comprehensive support system for our emerging producers, and that in many instances includes infrastructural development as well as a broader market space. Moving on to field crops then, here we've got a subsector where, despite the challenges presented by COVID-19, has actually had a very good 2020 season. The volumes have increased sharply year on year, and prices have also got support from the weaker exchange rate. Despite that, we still need to remember that many of our Western production regions are under quite severe pressure. They've had a number of difficult years, so producers in these regions are looking to alternatives, and we do see a structural shift there in terms of production patterns. Going forward, we have to acknowledge that crop rotation, diversification, and continued research and development to keep us on top of the productivity curve will be critical for sustainability. If we start again with global markets, what we're showing on screen is we're again comparing the time around the global financial crisis, which was of course the last time where we had a big demand shock to the global market. And we compare that to current levels in terms of stock to usage ratios. And what we see is that for the most part, agricultural markets are much better stocked than what they were just following the global financial crisis. This would suggest that prices may dip lower this time than what we actually saw in the financial crisis. If we look towards the right then, and the world price impacts that we have seen to date, we actually have seen some grain prices increase, and a lot of this has to do with policy responses. So the big one that increased was rice, and that has to do with some key exporters limiting exports from their countries in order to ensure domestic supply for their own consumers. For products that are more related to feeds, products such as maize, where we've seen quite a sharp decline in industrial demand in particular, we have seen prices decline. If one looks towards the region, then we also have to say that we have substantial opportunities for trade into Africa. Fadi mentioned this earlier. On the left, we're showing the SADC region. We're showing the region as a whole in dark blue, and in the lighter blue is the rest of the SADC region once South Africa has been removed. What that essentially illustrates is that South Africa is a critical player and a very big positive contributor to the trade balance within the SADC region. If we look towards the right, then we see that the African Union, that's still well negative in terms of trade balance, and while we have seen it improve a little bit over the past decade, still a region that's importing a lot of food products. And this is important because it speaks to the upcoming African Continental Free Trade Agreement. So this agreement, of course, has been delayed by the COVID-19 pandemic, but over the 10-year outlook, we do still expect it to come into force and then to provide additional opportunities and market space for South Africa. If we refer back to Ferdy's presentation earlier, you have to note, though, that we need to get the product mix right. So one of the products that we do currently export into the region is white maize. On the bar chart on the left, we're showing you white maize monthly exports from March to June. So this is, of course, the period that's been affected by the lockdown action. We've heard of a lot of challenges at border posts, products moving slowly through border posts as it's being exported into the region. But in general, with the big maize crop that we've had locally, we have seen that volumes into Africa have been much stronger than what we saw in the past few years. In June, however, the volumes exported into the rest of the world have been much higher than these regional exports. Part of that also has to do with prices. So if you look at maize prices across the African region on the right, you really see exceptional volatility in these markets. And this is a key factor because it just presents a difficult environment for South African producers to compete in. So you'll see in 2020 in particular, in recent months when the new crop came in, prices declining quite drastically, particularly true in Zambia. And Zambia, of course, is one country that's competing more and more efficiently with South Africa in terms of supplying maize into the region. So coming towards the outlook for white maize, then we see that over the projection period, we've got the share of exports in the total market actually declining over time. Now, this is partly attributed to the increasing competition that we face from Zambia, with Zambia having a more favorable transport differential into markets such as Zimbabwe, and with their non-GM maize obviously being very competitive compared to South African products. But the other side of that is also that we've got a generally weaker economic environment, and where we saw over the past 10 years that per capita maize consumption in South Africa has actually declined fairly consistently, we see that turning around over the outlook, particularly the early years of the outlook, with your consumer under significant pressure and shifting back to basic food staples, reversing some of the dietary diversification that we've seen in the past. The drop to export parity prices, however, coming off the strong production volumes, that is important and very critical for our consumers. So it's good news, obviously, from a consumer perspective, as it keeps the product fairly affordable. But it also, the reality of trading at export parity prices for a long time is that there's a significant share of more marginal area in the western parts of the country where this is just not a sustainable option. And when prices tend towards export parity, these producers come under pressure, And over the outlook, we do expect that we will lose around 200,000 of these hectares going forward. Here we show the impact of that profitability. So what you've got on screen is a basic cash flow comparison in the Western production regions in South Africa. It's split into three. So we've got normal or average production regions, we've got the higher potential regions, and then we've got these more marginal regions. What we see is that the good yields attained in 2020 have actually pushed cash flow positive for all these regions, having been negative in 2018 and 2019. But if we go forward with prices sticking to export parity levels and yields normalizing, those marginal regions then dip into the negative again and cash flow coming under strain once more. From a risk and probability perspective, we're now showing on screen these same three regions, so your marginal regions, your normal potential and your higher potential. And what you see in the green and red is the probability of generating a positive or a negative cash flow. So in 2021, based on the baseline projections, if we introduce historic uncertainty around that, in 57% of cases, the cash flow in these more marginal regions would be negative. This is then a big driver, this relative profitability and the area trends that we see over time, but it also, if you look historically from 2000, you'll see that this decline in white maize area is not exactly new. Over time, we've been able to grow productivity to the extent that we have been able to even grow production a little bit on a smaller and smaller area. So this relative profitability and export dynamics do influence this pattern, but also the relative demand for food and feed products. So despite the turnaround in per capita consumption of white maize, we do still foresee stronger demand from our livestock sectors, which are expanding. And so yellow maize and soybean area in particularly is expanding. But then something like sunflower, which is a mature market, a well finely balanced market, we see area largely consolidating and trending sideways over the outlook. If one adds to that area then production volumes and also prices, you get the gross value of production for the various summer crops, and you see a very similar trend. So firstly, in 2020, you see a big rebound in revenue generated from these sectors. That shows remarkable resilience because from 2016 to 2019, the sectors actually had a very volatile period in terms of weather conditions, and profitability for many producers came under severe pressure. If you look forward, then you'll see that on average over the 10-year period, the white maize value is actually declining a little bit relative to the strong 2020 performance, but your feed-related crops, your yellow maize and your soybeans, that's expanding relative to what we saw in 2020. That brings us then to soybeans in particular, which is arguably one of the most dynamic sectors in South African agriculture over the past decade. We saw very rapid growth in area and production levels. In the last 2 years, that area has declined marginally. We have had some challenges with yield. In 2020 in particular, the eastern regions, which is where a lot of the soybean production takes place, have not had as favorable rainfall conditions as what we saw in the west. With the exchange rate support, prices have increased sharply, and so we expect a significant expansion in area from 2021 onwards. Over the course of the outlook, we do still foresee production growth, but at a rate that's much slower compared to the past decade. That has to do with firstly us expanding into more marginal production regions, which are not as ideal for soybeans as the regions that we're currently producing on, but also because the industry is maturing. So in history, where we saw a lot of expansion in our crushing capacity, our production is now starting to catch up. The utilization rates are becoming more sustainable, but the demand pull from the livestock sector is also slowing. What we have to note is that if we are to attain the production growth that we show in this slide and push prices towards export parity levels, we really will have to accelerate yield gains relative to the past decade, and that can be attained by factors such as the introduction of the breeding technology levy, but also specifically the right cultivar selection for specific production regions in South Africa. So if we turn to oilseed products, then we see also that the significant investment that occurred into the oilseed processing sector has allowed us to replace a substantial share of imported products in the past. The chart you see in front of you is for protein meal demand, disaggregated into the different production types locally and then also the imported oil cake. You'll see that from 2009 to 2019, a huge expansion in the dark blue bar, which reflects domestically produced soybean oil cake, replacing that which was previously imported. Over the outlook, we do expect this to continue, but generally the demand for protein meal is slowing, and that's based on the slower growth we talked about in the livestock sector. We also do expect us to replace further imports going forward, but the small volume of imports that remain essentially will come into the coastal regions. And if we want to supply that locally as well, we really will need to reduce the cost of our inland transportation. The other product, of course, coming out of the oilseed processing system is vegetable oil. Here we've seen historically that palm oil plays a big role, so that's one of our major imported products. That will always remain because South Africa doesn't produce palm oil. But if we look towards the other three, we see a very similar trend to the protein meal. We've replaced a large share of imports with domestically produced soybean oil production in particular. And going forward, we project an expansion in both sunflower oil production and soybean oil production, and reducing that imported complement further. Quality is always an essential factor when it comes to processing and the competitiveness of processing. So what you see on screen is an extract from some work we've done related specifically to sunflower seed oil concentration. So on the chart it shows the oil concentration that was obtained from data in the national cultivar trials, and that's compared to the actual data that we see from silos. And you see that in the recent years there's been a real divergence there, with the cultivar trials yielding a higher oil content, but in silo actually getting a lower oil content. And of course this brings some pressure in terms of margins to your crushing industry. What's critical here then is cultivar selection again. So if in the table on the right we're comparing different cultivars, the first of which is available in South Africa and Argentina, but you can see the role of climate there. Over the same period, Argentina yielding a much higher quantity per hectare than what we saw in South Africa, and also yielding a higher oil content within that. The second bar then speaks to different cultivars in Argentina and South Africa, and there you can see that South Africa actually is able to close that gap a little bit with a different cultivar that's maybe more suited to our domestic production conditions. Another market where quality's made a significant difference is cotton. So if you look at the long-term view on cotton hectares, the stacked bar on the left-hand side, you'll see that cotton area in South Africa has been on a very long-term declining trend. Even in the early 90s, post-market deregulation, we see that we still produced more than 100,000 hectares of cotton in South Africa. That declined sharply in the period that followed, until very recently when we saw an uptick again in cotton production. Now that had a lot to do with relative profitability compared to other summer crops, but also improved technology, so improved marketing and also harvesting technology, which simply made the industry more competitive. A lot of the success has been built on exports. You see that since 2017, South Africa has become a net exporter of cotton lint. This goes predominantly to Asia. And again, it's a high quality product for which South Africa actually obtains a premium in the international market. Cotton is of course also a sector where small scale producers can thrive. So currently South Africa, around 70% of our area under cotton is attributed to small scale producers. But there is also scope to expand that. So what's encouraging is if you look at the area in 2017, 18, 19, when the industry came back and volumes increased again, we also saw an increase from smaller producers, firstly just in terms of the area produced by a similar number of producers. But in 2019 in particular, we also saw the number of producers increase quite significantly. Here we have a real opportunity to bring more producers into the sector, and that speaks specifically to the Makatini gin, which at the moment is estimated to only be operating at around 20% capacity. Much of that has to do with old technology, old machinery and infrastructure. And if we can replace this gin with a 20,000 ton capacity, more modern gin, we can add another 13,000 hectares. And this is important specifically for the region. Small scale producers can compete here, and it's also a region where sugarcane producers are actually coming under increasing pressure. So from that perspective, cotton actually presents a viable alternative for producers getting out of sugar. If we look towards sugar hectares in particular, then you'll see that over time we have lost a significant amount of hectares under sugarcane. There is some recovery in the short term, only a marginal recovery based on good yields and strong prices in recent years. But in the long term, we do still expect us to continue to that declining trend. And there's a number of factors that underpin that. The first is struggles to get productivity gains over time, much of which has to do with the climatic conditions in our sugar production regions. But secondly, also because we simply struggle to compete in the world market with low-cost producers, many of which obtain support in their country to produce then high volumes onto the global market, which in turn pushes prices down for South Africa. The third reason is one of our neighboring countries in Eswatini, which lost their duty-free access into the EU. As a result, they're pushing more product into South Africa under the duty-free SACU tariff agreement. which of course pushes more volumes into South Africa's market that we have to compete with, and labour generally in Eswatini would be cheaper than what it is in South Africa. The fourth was the recent introduction of the Health Promotions Levy, which led to a lot of the beverage producers shifting away from sugar, formulating away from sugar towards alternatives that could be either healthy or simply more cost competitive, given that they have to pay that additional levy. The sugar industry is also one that's been working on a master plan. While this master plan is less aimed at additional growth, more aimed at a managed consolidation to increase efficiency in the industry, but also to make sure that farmers exiting sugarcane have viable alternatives in the region that they produce in. This does, however, come at a cost, as we've already seen 2 sugar mills close operations in 2020. If we move over to winter crops then, this speaks very specifically to areas in the Western Cape. Winter crops in general are much more constrained by resources. I think Fadi spoke earlier to some of the policy actions that have been taken to stabilize wheat area in particular. But the total production region in the winter rainfall regions is fairly stable going forward, and what we see inside that is increasing competition from the different products rather than a total expansion of the area under winter crops. In the short term, that's very much favorable to wheat, as we have a product like barley coming under increasing pressure due to the fact that the single buyer, which is AB InBev, was not able to malt for quite a long extended period through the lockdown action. This of course influences the relative risks for producers, and given that they do well in the wheat market at the moment at a weaker exchange rate, we do expect some shift into wheat. In the longer term, that does decline again as the continued shift into rotational systems leads to some expansion in barley area as well as also canola. The reality, though, is that the constraints in terms of production regions and resources results in the fact that South Africa always will remain a net importer of wheat products. Currently, we import about half of our domestic consumption. That we expect to remain the case. So while area is fairly flat over the outlook, productivity gains do give us some production expansion, but the share of imports in the total market remains fairly constant. So that also implies that South Africa will continue to price wheat at import parity levels. Given that we apply the variable import tariff and that world prices remain below the price that triggers this tariff, it suggests that the major role player in terms of wheat price developments going forward is really the exchange rate. And so we see import parity levels and also the domestic wheat price following that trend quite closely. For barley and canola, South Africa is fairly self-sufficient, so it's a finely balanced market. In recent years, we've exported small quantities of barley, but over the outlook, we do expect to remain in a fairly self-sufficient position, with the price assumed to retain the link to wheat, therefore following a very similar trend to wheat. And then canola, of course, which competes for the same area, also follows a very similar price path to what we see in wheat. Canola is an interesting product because from a demand perspective, there's significant scope for expansion. It's well established now in the vegetable oil sector as a niche product in South Africa. From a protein meal perspective, it has a very unique market situation in that it has the opportunity to replace imported soybean oil cake in the Western Cape. That is expensive to move from our summer production regions, but canola cake can be utilized for dairy operations, particularly in the Western Cape. So far, production has not expanded to that same extent, mostly due to the fact that our yield levels are still low. So if you look on the chart, you'll see that South Africa's average yield levels don't compare very well to that we see in the rest of the world. But a small improvement in yield levels here will make the crop a lot more competitive compared to other winter crops. And there's also significant expansion potential for canola in the Eastern Cape if we can improve yield levels. To wrap up field crops then, we come to some critical factors again that speaks to accelerated and inclusive growth. Firstly, to note again that weather conditions in the western production regions have become increasingly difficult, so we see some shifts in cropping patterns. We also see producers including a bigger livestock component, that way diversifying their risk in the region. But if we want to get this region more sustainable, we really will need to look at something like crop insurance, which will only be viable if it is supported to some extent. We've highlighted the role of infrastructure and the cost of trade. So one of the key reasons why we remain a small net importer of protein meal, for instance, is because the cost of moving the product from the summer regions into the coastal regions is simply too high. And if we invest in rail infrastructure, we can reduce that quite significantly. The reality for this sector is that global prices are trending downwards and they will likely continue to do so in future. And from that perspective, continued productivity gains, but also a focus on things like quality, sanitary and phytosanitary measures and consumer preferences around the world will make sure that South Africa is able to continue competing in this environment. So if we move on to the last subsector, then looking at horticulture products, if we remember right from the beginning, this is a sector that's done very well and expanded quite substantially over the past decade. But its long-term nature also implies that a lot of the area expansion that we have seen will only enter production over the outlook. So we're looking at a 10-year period where we'll see significant additional volumes entering the market. From our perspective, we need to make sure that we have competitive access to export markets for these volumes, but also that we have the infrastructure in place in terms of port capacity and specifically port efficiency so that we can move these products out across South Africa's borders. So on screen in front of you, you've got South Africa's total fruit and nut exports disaggregated by country of destination. And what's evident is this is still fairly concentrated in the European Union, with almost 50% of South African products still destined for that market. But the one that we have managed to grow quite successfully and is also actively being targeted by the industry is the Asia Pacific market, where demand is still growing globally and where we expect it to have more market space going forward. In terms of product mix, you'll see that if you pull out South Africa's top 15 export commodities within the agriculture and food products, very many of those are attributed to the horticultural sector. So the big one is citrus, which contributes the biggest share of South Africa's agricultural exports. That's followed by wine, also fresh and dried grapes and palm fruit, all of which make a significant contribution to South Africa's positive trade balance within agriculture. In terms of relative market importance, the share on the slide on screen gives you an indication of how important exports are within each specific commodity. And what's clear is that particularly within the bigger products on the left, with the products being sorted from left to right based on production volume, the exports are between 50 and 60, 75% of the volume within the market. If you were to express this in terms of value, exports would play a much bigger role still. So in most instances, the domestic fresh market is quite a small component, and the growth and the success that we've seen within this horticultural sector has very much been attributed to the growth evident in export markets. What is important to remember, however, is that even though we've underpinned the growth strategy by export volumes, you also will grow, if you grow export volumes, you also will end up producing more fruit also for the local market and the processing sector. So we will also increase the volume of fruit coming into our domestic marketing channels. One of the key aspects that supports our competitiveness with respect to horticulture is also seasonality, and the fact that we're counter-seasonal to the Northern Hemisphere, where a lot of our product is exported to. With that respect, if one thinks about something like COVID-19 and the lockdown actions which influenced it over the past few months, you really need to look at which relevant products were in the market then. Unfortunately or fortunately for us, the biggest exporter was in the market at that time. So we really saw good coordinated efforts across the industry to make sure that our citrus products could still be exported. We had a very big crop and we managed to move volumes through the harbours despite many challenges, which is part of the success that we've seen within South African agriculture in 2020. What that also implies is that going forward, we need to think about things like port capacity. It has a challenge that has come up through COVID and the lockdown action, but it's not new. It was already a challenge in 2019 when it influenced citrus export volumes in particular. So what you've got on screen is the three major port regions in South Africa and the fruit mix that would typically be exported from them. So in 2019, South Africa moved a staggering 261 million export cartons through our ports. 37% of that went through Durban Harbour, which is quite concentrated in terms of citrus and avocados, both of which are in the market at the same time. So this would imply that you can easily end up with a congested situation through the months that those products move out. The Eastern Cape is smaller, around 16%, and a lot of that is attributed to citrus, but also with some palm fruit. And then the Western Cape, where almost 47% of our volumes move out, is a much more diversified product mix, with palm fruit being the biggest contributor, followed by grapes and citrus. If one looks towards the future, however, the reality is that by 2029, our projections indicate that we'll have to increase those volumes that move through these ports by 40% to reach 367 million cartons exported. And given that we're already challenged in some months with volumes and congestion in some of our harbours, This is a very important aspect that we need to remember and need to make sure that we're able to get to in 10 years' time. That speaks very specifically then to the expansion that we have seen in the industry. So stacked on the chart in front of you, you've got a view to the major fruit types in South Africa and the expansion over time. So in terms of hectares, if you combine pome fruit, stone fruit, citrus, table grapes, avocados and macadamia nuts, we've seen an area expansion over the past decade of 47%. Given the delay in production, the fact that many of these long-term crops take multiple years to enter production, a lot of that expansion will only become evident over the outlook period, and there we see production volumes expanding by 33% over the next 10 years. What that implies for export volumes, we've got on screen now just a view to seasonality with citrus. What it shows is a 3-year average in terms of the blue line of export volumes within specific weeks from South Africa. It overlays that also with the year-to-date exports for 2020, where we've done fairly well, but then places on top of that 2029. And there you can see that for total citrus, we have to expand this volume by 46% over the next 10 years. So one can't overemphasize in this regard the criticalness of efficient ports and getting product moved through those ports efficiently. A lot of the commodities where we see more expansion over the outlook are some of the smaller ones, something like avocados. These commodities are less mature, specifically also in the global market. Avocados being classified as a superfruit and macadamia nuts. These are newer products, so it's products where we still see or foresee per capita gains in consumption in the global market. So there's arguably more space to grow our markets in these. For avocados, we still expect an expansion of almost 80% over the next 10-year period. And for macadamias, that's a little bit lower at 70%. Critical though is that again, these products take a long time to enter production. Macadamias only reach full bearing after 10-12 years. Avocados take 7 to 8 years. So some of the volume that we see in that area expansion over the next 10 years will actually also only enter production in the period that follows that. Macadamias in particular, as we've said, all these horticultural commodities are long-term views, but macadamias, that's particularly true. So what we're showing on screen is just a breakdown of the costs associated with establishing macadamias, and then we compare that to the income generated, given that we take 12 years to get to full bearing age. What that implies is that from establishment, we stay in a negative position in terms of profitability, and we only break even in year 11. Now, this is important because a lot of producers have made a really long-term commitment in expanding area here, but it's also important because if we think of something like inclusivity and transformation, it implies that it's a really long period that you need to support producers for if you want to bring them into this industry sustainably and allow them to generate an income from this industry. Given the long-term nature of this investment, we really need to come to the party in terms of market access. So we noted earlier that a lot of the growth in exports will likely come from the Asian region going forward, where we see demand for fruit products still increasing. On the table that you see on screen, we've compared South Africa's tariff situation relative to our major competitors in these Asian markets. Essentially what it means that any green block, there's a preferential tariff agreement in place between the exporter and the importer. And if you look at South Africa, we only really have that preferential agreement in India, whereas our competitors have trade agreements all over the show, which allows them to access these markets more competitively, where South Africa would be subject to the most favored nation tariff, which is then higher than what our competitors face in these markets. Despite that, South Africa has grown its share in the global market for fruit. So what you see on screen is the total global volume in the bars being exported of very specific fruit types. Disaggregated into total full year, so in a complete calendar year, and also then in light blue, the share being exported in the time when South Africa is in the market. So South Africa has increased its share in orange exports, for instance, to 20% of the global market, but if one looks only at the period where our citrus is actually moving out of the country, that share is as high as 40%. Macadamia nuts, we're also at 40% already, and what this implies is that if we push additional volumes into these markets over the next 10 years, we are likely also to influence global prices. In citrus, that's particularly evident if one looks to the price projection. So in the past, you see on screen the nominal prices and the real prices where we've accounted for inflation. And over the past decade, we've actually seen a substantial increase, at least to 2016, in real prices, which is in part what's underpinned the success that we've seen in this sector. Over the past few years, as those additional volumes enter the market, we have seen those prices of lemons and limes and citrus and soft citrus in particular declining. And over the course of the outlook period, we do see real prices declining quite significantly as a result of these additional volumes coming into the market. The result of that then also spills into our area projections. So if you look at citrus in particular, you'll see that following this period of rapid growth, we actually see a flattening of area growth over the outlook period, so quite a significant slowdown in area expansion. And this is also true for some of our other major commodities. Something like table grapes has also grown rapidly in the past. In recent years, it's become increasingly challenged in terms of competing with South American competition in particular. Think of a country like Peru. So going forward, we do see some consolidation. We see a slowdown in area growth as we focus more on quality and less on quantity to make sure that we compete effectively with those South American products. The other side of that is that for something like table grapes, which is predominantly produced in the Western Cape, there's also a limit as to how much you can expand area in terms of resource potential and how much area we have that's suitable for table grape production. The other sector, which is also fairly concentrated in the Western Cape in terms of production regions and therefore also constrained in terms of resources, is palm fruit. So on screen you've got the outlook for exports in terms of tons and in terms of value for apples and for pears. And there you can see again that where we have apples expanding, so apples have the benefit, of course, that under controlled atmosphere storage you can store most varieties for a full year period, so that broadens your market access window. It also makes the product more able to export into Africa, for instance, where it can deal better with the challenges in terms of infrastructure and time taken on the road. So this is a market that's grown quite considerably for South Africa. A lot more products being directed into Africa over the past decade, and specifically with the African Continental Free Trade Agreement coming up, it's also a market where we see quite substantial growth in the future. On the pear side, that expansion is then more limited, obviously competing for the same resources, and therefore you see a lot of producers increasing the share of apples in their total palm fruit production component relative to pears. Apart from that, one also has to consider risk and uncertainty. So here we come to plums, and what we show on screen is again the result of a risk analysis. So what we've done is we've looked at historic volatility in terms of yield levels, pack out percentages for exports, and then export and domestic prices. And if we apply that to the plum industry in particular, we see really a very broad band between the top end and the bottom end of the outcomes. And what this would be indicative of is that there's a huge risk factor within these markets. So fruits in general is a very long-term sector. It's a big investment. It can do very well. There's a lot of opportunity to make good profits, but things also have to go very right for that to happen. And there's also a big downside in terms of risk. So from that perspective, it's really a difficult industry if you think about transformation and introducing new players into this industry. And one really then has to think carefully about the support structures that you provide when you want to bring new players into the sector. The other one that's also been competing very strongly for resources and a sector where we've seen some significant consolidation in the past is wine. So if one looks at the number of vines in production in South Africa over the past decade, that's declined by around 13%. Much of that has to do with the relative competitiveness to fruit. We have lost a fair amount of wine area to products such as soft citrus, which was simply more profitable given the real increase in prices at a time when real wine prices were actually declining. The sector has been through this period and was sort of starting to stabilize, with producers starting to reinvest towards the end of last year. 2020 was shaping up to be a good year, but then of course COVID-19 struck, and the wine industry from that perspective has been one of the most severely impacted by that situation, predominantly because of the trade restrictions that occurred firstly for exports and secondly then into South Africa's domestic market. So if one considers the market balance for wine historically, we see that from 2009 to 2013 we had rapid growth in the industry, in fact more so than what the market was able to take up in terms of exports and domestically. The industry then went through its strategic exercise, and what followed was a period of consolidation where they really rebalanced supply and demand. Production volumes declined. The industry made a very conscientious shift towards value, reorientating the market towards that. and made significant progress until 2020 came along, of course, and from that perspective, the trade restrictions imposed has really put the industry back a far way. So if you see at stocks, for instance, in the grey bar, the extent to which stocks have run up again in a short time due to the fact that the industry couldn't trade for several months. It's also important to note that it takes, within this lower economic growth environment, it takes us a long time to work these stocks out of the market again. For that reason, we still see some reduction in the short term, with production only stabilizing over the second half of the outlook period. So to wrap up horticulture, the critical factors to accelerate growth, in addition of course to supporting our domestic wine industry, is the substantial volumes that will be entering the market. We know they're coming. A lot of the area has already been established, and a lot of the area will still be established in the next few years. But we need to make sure that we have competitive market access for these products. A lot of it will be exported, and we need to make sure that our ports are efficient in moving these volumes out. We also need to make sure that we can compete efficiently in international markets. We are facing increasing competition from South America in particular, and we need to make sure that our quality is on par to be able to compete with those producers. In terms of our target market, a lot of the product moves to developed regions where your consumer has preferences in addition to the economic ones, so things like quality and consistency, and also sustainability in terms of things like packing material become increasingly important. Lastly, the long-term nature of the industry and the sheer size of the investment required to enter it also implies that we really need a long-term and a patient support structure if we are to bring new entrants into this market. So we've gone through a lot of slides, we've covered the baseline outlook in a lot of detail, but I want to just take a step back then and bring you back to the topic of the presentation and what Fadi spoke about earlier, is that we really shouldn't be aiming for the baseline. We should be aiming to accelerate the growth that we see in the baseline, which really reflects a business as usual scenario. And we know that business as usual won't be good enough going into the future. So to finish us off, I just want to draw your attention back to the slide which also presented the end of Fadi's presentation earlier, just underlining the preconditions, the 4 pillars essentially on which we feel accelerated growth in the sector can be achieved. The first of those is investment and the general security around the investment environment. The second is support and innovation, which speaks to finance, policy support, the general comprehensive support system required for our agricultural producers. The third is infrastructure, which speaks very much to reducing the cost of transportation, but also ensuring efficiency through our ports for a lot of sectors that are basing the growth strategy on exported products. And the last, of course, is markets, which speaks to increased market access, broader market access, but also more competitive market access, and also the general environment of plant and animal health that we need to achieve in order to make sure we can access these markets. All of that then comes back and needs to be underpinned by an efficient and coordinated institutions and departments which are able to implement these strategies. Thank you.